Okay, next let's spend a little bit of time, once we've identified the risk, trying to work out how serious these things are. And it's at this point that the risk management process starts to take a little bit of shape, to be honest, because round about now we're going to start to put some priorities onto the different risks that we've identified and say, well, we've got these hundreds of things we've thought of, but these 3 or 4 are much more important than the others. There are various ways in which we can come to an understanding about how serious a risk is. The most common one, though, is to compare and compound probability and impact or size. So how likely something is to go wrong and how serious it would be if it did go wrong, combining those 2 things together give us a bit of a feel for how serious a risk is likely to be. Looking ahead, we can scenario plan to try and work out which risks we need to worry about more than others. And scenario planning means looking at plausible, although reasonably extreme perhaps, future circumstances and thinking about how that would affect our business model. So for example, as an airline, we might say, wonder what happens if our fuel price were to double over the next 5 years. Now that's a big movement in fuel price, but it's not unheard of. You know, you get get a war breaking out in the Middle East and the price of oil could double quite easily. So we then work backwards and say, how does that affect our business? In other words, what level of exposure do we have, therefore, to fuel prices? And scenario planning can help identify those variables that we need to worry about more than others and to focus in on more than others. We could use expected values as a way of quantifying risk, and this is the idea of probability times impact. So for example, if I think something is 50% likely to happen, and if it does happen, I think it will cost me $1 million, then multiplying those 2 together gives us $500,000 worth of risk. And that gives us a sense then of scale. The only issue really with expected values and doing this kind of analysis is that it's assuming we have all the numbers to hand. How likely things are to go wrong. We've got a percentage here of 50%. The exact value impact if it does go wrong, we're saying $1 million here. And we may well not have that kind of information in the real world. Now, lots of outsiders, when they're assessing how well or otherwise our business is going, will look at accounting ratios to inform them, to let them know. So one way of thinking about risk is to think about how it affects our reported accounting ratios. So you do need to be familiar from your earlier studies as to what the accounting ratios are, the main accounting ratios, and what they mean. So to be able to interpret them as saying, well, that's high risk or that's low risk, that kind of an idea, typically in comparison to an earlier period or to another business. So key ones that you need to be aware of is gearing, typically measured as debt over debt plus equity times 100%. Now, high gearing is risky financially because you have to pay your interest and your capital repayments according to a contract, otherwise you'll be in breach of that contract. And unfortunately, shareholders bear the brunt of that risk because we don't have to pay shareholders a dividend, so lenders will get paid first. Another way of thinking about the gearing level is it uncomfortably high or not, is to look at interest cover. Interest cover, profit before interest and tax over interest. And if that's a comfortably high figure, then that's telling us that it was reasonably easy to pay our interest bill, so we should feel relatively relaxed. If the interest cover ratio gets close to 1, then it's time to worry. You might be able to relate this to yourself personally. If you happen to have a mortgage, for example, and your monthly interest is close to your monthly earnings, life is very uncomfortable. But if your monthly earnings are several times more than the interest you have to pay on your mortgage, life is much easier. Exactly the same applies to a business. So that's looking really at the longer term debt versus equity type situation. But shorter term finances give us risks as well, because if we run out of money to pay the bills, then we go broke as an organisation. So the traditional gearing ratios, current ratio of current assets over current liabilities, and making sure we have enough cash and near cash assets to pay our immediate liabilities. We may decide to exclude inventory from those current assets if they take a long time to turn into cash. So we may look at the quick ratio, which is current assets less inventory over current liabilities, and hopefully we have sufficient non-inventory related current assets to be able to pay our bills. It's important in the exam, though, not to conclude on one number. If someone says, oh, we have a quick ratio of 0.8, that's really low, you have to be a little bit careful, because it could be a lot better than it was last year, and it could be a lot better than our competitors. So you're much safer ground with ratios, comparing them to something else and commenting on that more objectively than just giving your opinion as to whether something is high or low. We could also, when it comes to identifying risk, think about how things change if a variable changes a little bit. And this is known as sensitivity analysis. So you might say, for example, if the exchange rate increases by 15%, what will that do to our profits? And if we decide, well, our profits will only reduce by 0.01%, we might conclude we're not very sensitive to exchange rates. We don't need to worry too much about them. But if, as say, a 1% movement in exchange rate completely eliminated our profits, then we would be incredibly sensitive to those variables. And the idea here is that the variables we're more sensitive to are the ones we should be more focused on when it comes to risk management. Now, as we come to prioritise the risks, and we're getting a feel for what probability is like and what impact is like for the different risks, we may start to pull this together, possibly diagrammatically, to start looking at the picture that we're facing in terms of risk. One way of doing this is to produce a risk map, sometimes known as a heat map, this one, which has probability on one axis, impact on the other, and sometimes it even has a line drawn down the middle of the graph, which is a boundary of how much risk we're prepared to tolerate before we need to take action. So things over on the top right hand side of that boundary would be risky, so high impact, high probability. We need to do something about those risks. Things that we're spotting down here in the bottom left hand side, we don't need to worry so much about. Trying to eliminate risk entirely, I'll be perfectly honest with you, is futile, because you can't do it for a number of reasons. Firstly, risk has an element of unexpectedness about it. Some risks you might anticipate could happen, but there will always be things that happen that you couldn't anticipate. So you can't eliminate risk entirely. There's human error as well that you need to bear in mind. And it's very difficult at times to cater for that. In addition, trying to eliminate risk is often actually very expensive. There's sort of a law of diminishing returns here, that when you're faced with a risk, there's often something you can do pretty much straight away that reduces risk significantly and relatively easily. If you want to reduce risk any more, then it takes a lot more effort to try and reduce risk, and so on and so on. So rather than trying to eliminate risk entirely, we try to reduce risk to a level that's as low as reasonably practical, where the trade-off between risk and cost is optimized. And that's known as ALARP, which just stands for as low as reasonably practical. So we're not trying to eliminate risk here, we're just trying to reduce it to a relatively low point. Now, as we are plotting all our risks on this risk map, we need to pause at this point before we decide what action we're going to take, because risks very rarely exist in isolation. Some risks compound each other, so they make things worse because they feed off each other. So a health and safety risk might lead to a financial risk and a legal risk, and they all sort of feed off each other because they are positively correlated. And we need to be very careful then that what we might have originally perceived as a relatively small risk is actually considered carefully if it feeds other risks as well. However, you can get the opposite effect happening. You can get risks that are inversely correlated. So as one goes up, the other comes down. So for example, if I'm looking to increase automation in my factory, I might be concerned that, well, automation exposes me to operational difficulties if the machine's grind to a halt. Well, that's true, but by automating more, we are less reliant on humans, so there's less chance of human error. So to a degree, at least, those two net off against each other a little bit, which might mean in the round we decide that we don't need to do so much about trying to manage that risk. So it's important before you decide what action you're going to take is that you stand back and take a look at the main risks you identified and think about how they feed off each other before we decide how much action we're going to have to take. So, step one of the formal risk management process is to identify what could possibly go wrong. And we've had a look in this chapter at strategic risk versus operational risk and various other definitions to give us a checklist to work through to help identify risk in the first place, a very difficult starting point. What we've then done is take some time to consider how serious the risks are by looking principally at probability and impact, because we're going to focus our attention going forward on those risks with the higher probability and higher potential impacts. We've looked at that by assessing each risk individually and drawing them potentially on a risk map. And then we've taken a step back to look at the bigger picture and say, are any of these risks correlated in any way? Do we need to consider how they feed off each other before we then go on to the next step of deciding exactly what we're going to do about these risks?